and would like to take the opportunity to present to you some of the views related to Islamic finance and sustainable finance from a viewpoint of a practitioner. And what I've seen over the last more than 2 decades is that there have always been tensions, conflicts between Islamic finance and traditional finance. And now we are seeing what we call a new age of finance. This new age of finance is being driven by 2 major, what I call systemic shifts that would disrupt the way the old style of banking has been conducted in the past. The old traditional banking has been on what we call financial intermediation based on lending, borrowing and lending. The bank borrows money from the savers, those who have surplus, and then channels the savings that the bank has borrowed to their own customers who are borrowing from the banks. So it's essentially a risk transfer mechanism. The savers transfer the risk of their savings deposits to the bank. So the bank borrows the money from the customers and then lends it out to their clients. The bank transfers the risk to their clients, sometimes without any security, what we call clean facilities, sometimes with collateral. But with these 2 systemic disruptions, the way banks are operating has changed and will continue to change. The first major disruption is what we call technology. Technology advancing so fast that is enabling non-banking institutions to challenge banks in doing banking business in a much more efficient manner, what we call cheaper, better, and faster. So today, you don't have to walk into a bank. 10 years ago, you have to walk into a bank to transfer money to Indonesia, to any other countries, for example. Today, you can do it through many, what we call financial technology companies or remittance companies, who are taking away that banking function. Payments was the core, one of the core functions of a bank. Today, that can be done by non-bank through digital platforms. You can send money now through your app with a non-bank, what we call technology company. They'll be able to facilitate the payments in a much cheaper, better, and faster manner. The same goes with payments for your normal day-to-day purchases. You don't have to use what we call a debit card or a credit card to pay. You can pay through wallets, touch and go wallet. You can pay. You can have Boost. Different types of wallets have come up, and now you have QR payments that you can then use to make your payments. You can select to pay from your bank account, your debit cards, your credit cards, or your wallet. Then you're also looking at technology companies coming in, applying for digital banking license. Malaysia is looking at issuing 5 new licenses for digital banks. And these digital banks are supposed to provide banking services to the underserved and unserved segments of the community or economy. So it could be micro businesses, could be microfinance to individuals, could be agri-finance to the farmers. These are the type of new economic activities that these banks are supposed to nurture and to facilitate the financial intermediation. So there's one side where it's really exciting. Banking will survive because banking is a very fundamental economic activity that helps the economy to get full capacity. Sorry, just give me a second. I'm sharing the screen. You guys, I'm sorry, you're not able to see the screen?
Yes, we cannot see the screen.
But I can see, I'm really surprised. I can see all of you, and I can see, what do I do now? Can you see my deck, my PowerPoint deck?
No, can Dr. Fadila, can you please help?
Because it says here I'm sharing. There's a red box here to say I'm sharing.
I think ini didn't share. Let me stop the sharing and share again.
Okay. But can you see my video?
We can only see your face,
Oh, okay,
not
but
the
you can't see
screen.
my slide. Okay.
Yes.
Can you try to share again?
Yeah, I'm the co-host now. Just give me a second.
Yeah.
Let me see. Can you see now?
Yes, now we can
Okay.
see.
Okay. So if you look at the other, so whilst the first, what we call change that's happening at a very rapid pace is what we call digital disruption, where new entrants are coming in to basically taking away a lot of the banking functions. So what will happen in future is, while banking will survive, the traditional banks, the way banks used to operate, may not be the same. Banks will have to evolve, has to adopt, has to adapt to the realities, new realities on the ground. And while this trend has been going on for more than a decade now, the last 18 months since COVID started, it has just been accelerated at a phenomenal level. So whatever the institutions like UI has been teaching in the past and what the students have been learning, so this all have to be unlearned and relearned, because we ourselves as practitioners, we are constantly seeing a systemic shift towards the new norm, where the way you are making your payments, the way you are doing your remittances, the way you are, for example, doing your trade, if you're buying from abroad, the trade transactions, all these the nature of all these transactions is changing at a rapid pace. So whatever we have been doing in the past in a certain manner, so like if you are used to put ATM card into the ATM machine to take the cash, that will change. So in many countries, you don't need an ATM card. You just need to bring your phone to withdraw money. There is a way to recognize your phone, and that will enable you to withdraw your money. Plus, of course, anybody can steal your phone and use it, but there will be added biometric verification. So all these things will change over time. The second area where we're seeing a significant shift is what we call a shift towards sustainable finance. And this is the topic that I want to discuss today. And I think I have about 40 minutes or 30 minutes to complete this. Is that right?
Mr. Rafi, you can have until 1 hour.
Okay.
30 minutes to 1 hour.
Okay, and what I would like to, given that the professors and teachers are on this call, if anyone needs additional clarity or additional information, it's good to have a dialogue as opposed to what we call completing the whole talk and then have a discussion. It could be more effective if anyone has any point to discuss, to raise their hands and we can discuss at that point. So
Okay.
the second shift that's happening is what we call a shift towards sustainable finance. So traditional finance, conventional finance, and Islamic finance has been operating on a certain model, which is what we call based on shareholder capitalism. Shareholder capitalism is about doing the business of banking in a certain way to maximize the return to the shareholders. But in the last decade, this shift has been moving towards what we call stakeholders capitalism. That means the role of a bank is not only to maximize the return to the shareholders, which is what we call profit oriented. The role of a bank is to also focus on creating maximum benefits to all the stakeholders. beyond the shareholders. That means you have to focus on the shareholders, because the shareholders are the one who are giving you the funds. They are the Rabbul Mal. And you owe a duty, fiduciary duty to your Rabbul Mal. But you also need to have responsibility for other stakeholders, principally your regulators to the central bank, which we have always been, because they've been regulating us for decades. Third, responsibility towards the community. You are serving a certain community in each geography, so you owe a responsibility to make sure that you tackle, the bank has a responsibility to tackle the problems that is caused, like inequality of wealth, inequality of income, inequality of opportunities, that is somehow directly or indirectly linked to the provision of finance by the banks. Then we also have responsibility to the planet, to the environment, because banks being the engine or the heart that pumps liquidity to the financial system, to the economy, to ensure that the economy reach full capacity, has wide range implications. Whenever we intermediate, that loan, that financing, that financial intermediation is creating impact, some of it positive, some of it is negative. So if we give money to a plantation company that is destroying the forests, deforesting, or disrupting the peatlands in order for them to plant, these will have severe consequences to the environment. So what is our role in managing the negative impact? And we also have a responsibility to the civil societies who are concerned about the well-being of the people and planet, and also the well-being of the customers. How do we make sure the customers who are buying the products from us are having what we call the financial stability that the products are supposed to achieve, as opposed to leading to financial hardship and financial harm, consequently leading to bankruptcies and insolvencies? How do we avoid that? So these are bigger responsibilities that the banks are now focusing on, is being driven by principally the regulators and the shareholders. A lot of the shareholders, particularly the institutional shareholders in Malaysia, like the likes of EPF, PNB, Khazanah National, these institutional investors are imposing these higher responsibilities. In a way, these higher responsibilities are similar to this concept of Maqasid al-Sharia. And we will delve into it in more detail in subsequent slides. So if you draw back all these new responsibilities on banks, it actually ties back to the original concept of Islamic banking, which was based on risk sharing. If you look at the entire ethos of risk sharing, and you can see it's a tall objective, it's a high objective to achieve, and Islamic finance has always been struggling to achieve this. Risk sharing, the very root basis or foundation of risk sharing is sustainability. And it will be very clear why risk sharing is the most sustainable method of financial intermediation is risk sharing creates the equilibrium. When the Rabbul Mal gives money to the bank as the Mudarib to invest in various activities, the banks will only share profit if the underlying activities are what we call revenue generating, they are profitable. If there is more profit, the banks will share a higher return on the capital invested by the Rabbul Mal. If there is less return, less profit, there will be a lower return to the investors. So it is a fairer means of distribution. If the economy is doing well, you will get a higher return as the Sahibul Mal. If the economy is not doing that well, or if this current climate like pandemic, where a lot of businesses are showing losses, the Rabbul Mal may not get any return, may even eat into their capital. So this way, there is what we call a fairer distribution of wealth. And if this is the method that the whole world has adopted, we will not see the rising inequalities that we are seeing now. So the risk sharing is based on these two cornerstone principles. One is it is a fairer and more equitable distribution of wealth, and that will lead to what we call a more just society. And also it will be more sustainable to the environment as such, because the Rabbul Mal will then choose the type of investment they want to invest in. So if I invest in a mudaraba that is going to pollute the environment, there is a direct impact to me. There's no risk transfer because I'm sharing the risk. If that plantation then is, fined by the regulators because they have caused impact to the environment or caused pollution to the rivers and to the atmosphere, then that will have a direct impact on my returns on my investment. But in a risk transfer intermediation model, where the banks basically transfer the risk to the companies and they take security or collateral, the impact to the banks is rather limited. The company will have to pay the fine. The company may be, financially in difficulties, but the banks will be able to extract the interest or the profit in a fixed rate Islamic financing, and the depositors will get a fixed rate of return on the deposits. So in this way, it is not aligned. So Islamic finance has always been trying to achieve this higher objective called risk sharing through mudaraba, musharaka, and wakala methods, but it has not been able to achieve. And we all know, as students of Islamic finance, we have been debating this for the last 3 decades, that we have not been able to achieve our risk sharing ideal, despite IFSA in 2013, introducing the investment account in Malaysia. And we will look into what are the real reasons why investment account has not been successful. Is the slide clear in terms of the visuals and?
Yes, Mr. Rafi, it's clear.
So what we find very quickly, what's happening in terms of why Islamic banks have not been able to shift towards what we call the risk sharing or profit and loss sharing method of financial intermediation. There are many reasons. Often the blame goes to the bankers, saying that the bankers have not been proactive, have not really pushed hard. They've taken the easy route of just mirroring the conventional products and not going through the extra mile to push this genuine, what we call risk sharing products. But the reality on this slide, we will show that it is almost impossible for Islamic banks to offer risk sharing products. And the analogy I typically use is Islamic banks have been trying to play football or soccer on a rugby field. So let's assume in Malaysia, we don't have any soccer field, and someone has introduced football, and then we are supposed to play football on a rugby field. And you find that however hard you try to play, you will not get the same enjoyment, the same effect of playing football if you try to play it on a rugby field using the rugby goalpost. So what's happening now is we have not created the landscape to efficiently do risk sharing. And what we found was IFSA in 2013, Islamic Financial Services Act, tried to create that football field. But what we find is the country itself, the entire economic system has been built to accommodate rugby as a main sport. However hard you try to introduce football, there are no takers. And we will show in this slide why is that. You see, banking, the very essence of banking is based on fractional reserve banking. That means when you deposit money in a bank, the bank is able to use that deposit. The banks only need to keep 2-3% as reserves, meaning they keep that as a reserve in the central bank, as statutory reserve. The remaining, they can lend it out, whether through Islamic financing or through conventional loans. So when they lend it out, so you put 100 ringgit in a bank, the bank gives 3 ringgit, 97 ringgit goes to another bank. Because customer who takes a loan from this bank eventually is going to put the money into another bank. Because when they buy a property or a car, the seller, the vendor will say, pay into my bank. So bank A gives 100 ringgit financing, bank B, sorry, 97 ringgit financing, bank B then receives the 97 on behalf of the seller or vendor. Then that bank now suddenly has 97 ringgit worth of deposit, bank B. That bank will keep 3 ringgit and give another loan of say 93 ringgit to another seller. This seller could be someone who sold some goods to a merchant, and that seller's bank is bank C. So suddenly you have seen within a few seconds or minutes, your 100 ringgit deposit in bank A has created 97 ringgit financing in bank A, 93 financing in bank B, and 90 ringgit financing in bank C, and it goes on. And with this multiplier effect, for every 100 ringgit of deposit creation, you can create up to 1,000 ringgit worth of financing. So fractional reserve banking allows the banks to create huge amount of liquidity through this concept called credit creation. Now, because they're able to create a lot of debt, the cost of debt comes down. That's why today you can go to a bank and get a home financing, a home loan for 30 years at 3%. If you go to the fixed deposit side, you put money for 1 month, you get close to 3%. So the bank is borrowing on the fixed deposit market for 1 month, 3 months, around 3+ percentage. And then it gives you a home financing for 30 years at 3%. So the financial intermediation through fractional reserve banking is the most efficient way of creating this banking, what we call credit creation. This leads to high corporate debt because customers can borrow at a cheap rate, particularly the companies. The companies are saying, if I can borrow 10 million ringgit, whether through Islamic tawarruk or murabaha or through a term loan or a credit facility, and I only pay 4%, 5%, why should I take a mudaraba or musharaka from you? So let's say I own a company, I produce gloves, I sell, I make 10% profit margin or 20% profit margin. And if I do mudaraba, I have to share the profit margin with you. Maybe you want 30%, maybe you want 50%, because you are putting capital as Rabul Mal. But if I take a murabaha financing, I only have to pay 3%. So naturally, as a customer, I don't want to take a mudaraba financing. Why I don't want to take a mudaraba financing is the fractional reserve banking allows the banks to create financing at a cheaper rate. Consumer also the same. I mean, it's very difficult to do mudaraba on a car financing. How do I compute the profit? Okay, please use the car. And from the profit you generate, give me a share of the profit. But you say, look, I don't create any profit. No, it's okay. You use the car to go to URA to teach. You earn 10,000 ringgit. From the 10,000 ringgit, give me a profit. Because without the car, you would not go to teach. Therefore, from the salary, give me 20%. So there's a lot of complexity on the consumer side. And the other anomaly is that if the corporate takes a financing, whether Islamic or conventional, that financing is tax deductible, meaning the interest he pays or the profit he pays every month, the 4% I charge, that is deducted from his income. So he doesn't have to pay tax. So the interest and the profit payable in financing is considered like a rent, like a salary. And therefore, he reduces his tax burden. But if he were to take a mudaraba financing, musharaka financing from an Islamic bank, that mudaraba will not be tax deductible. The mudaraba profit share will be net, or rather will not be tax deductible, and therefore he has to pay from his net profit, which becomes costly to the corporate. It becomes a major disincentive. And because the consumers are able to get more and more loans, because banking is able to, fractional reserve banking is able to create more loans. So in the past, when I started work, car financing maximum tenure was 5 years. And car prices was literally 40,000 at that time, 50,000. Now car prices have increased, although locally produced cars are quite constant, but car prices have gone up. But for you to be able to buy those cars, you will then ask for a higher salary from your employers. But instead of paying you higher salary, the banks were pushed to give longer tenor financing. So 5-year car financing has become 9 years, 20-year mortgage financing have become 30 years, 35 years. So you don't have to go and demand a higher salary because you can now pay over 35 years. So all these things have rather convoluted the market to demand more debt-based products. And the biggest factor that influences why customers want the conventional type of banking, where you as saver, all of us as savers want to put money in a bank, is because of deposit guarantee. The government guarantees your deposit in the bank. If you put money in your investment account, there is no government guarantee. So the argument was, well, you are putting money in an investment, therefore investment should be risk sharing. Why should there be a deposit guarantee or any form of guarantee? The argument for that is, your deposit in a bank is not a deposit. You are lending money to the bank. The original meaning of deposit in Islamic law, as well as English law and Malaysian law, a deposit is your safe deposit box. When you put money or your jewelry, your valuables in a safe deposit box in a bank, that is the definition of deposit. When you deposit your money in a bank, in a current account or a savings account, that is not a deposit. It is not a wadiah. It is a qard. It is also a qard in common law. If you look at the original position of common law, when the goldsmiths took the gold, there were two types of transaction the goldsmiths were doing. And you have to study the history of goldsmiths to understand how banks evolved. In those days, in the 18th century, when you give deposit gold, there are two types of transactions. One is, they used to give gold in a money sack or a sack of a coin sack, where they will tie the drawstring. So this is called a locked gold sack or knotted gold sack. That will be deemed as deposit. That will be kept segregated, and that will be a wadiah. You have to pay a fee. But if you don't tie the sack, you give it to the goldsmith will take it as a loan to him, and he will pay you interest. So even in the original goldsmith model, there was a deposit window and there was a loan window. Now in conventional banking, modern banking, both are considered as a deposit. So when you put money in a safe deposit box, the government doesn't guarantee. If the whole deposit box floor has been destroyed by fire or flood, you lose everything. There's no guarantee by the government. But the loan counter, where you have put money as a loan to the bank, that is guaranteed by the deposit guarantee scheme, PIDM, and lender of last resort. So this basically creates that incentive for you and me to put our money in a bank because you feel it's safe and secure. And in return for safe and security, you get a very nominal return, hardly anything. So this takes away your incentive for risk sharing because you feel this is much easier. I don't need to use my brains to figure out whether my investment is risky or not risky. I put my money, I forget about it and get a return, a small return or very nominal return, but at least I'm happy. My money is always there. When I put my card in my ATM, is secure, is always there. But because of your lack of what we call a lack of incentive to monitor what the bank is doing with your money, it creates a moral hazard. And this is the moral hazard. If you look at this chart, you will see these deposit insurance and fractional reserve banking will always lead to a crisis. So if you see the 1930 crisis, the Great Depression, and then this chart also shows the global financial crisis. In 1930s, in 1933, the peak of it, it's about 4,500 banks failed. In total, more than 9,000 banks failed in the 3 years. But that year alone, more than 4,000 banks filed for bankruptcies. And during that period, you'll see the other chart, there's a huge shift of wealth to the 10%. 10% of the population had 50% of the income of the entire economy. So whenever there's a financial crisis, the rich gets richer, the poor gets poorer. And then you see there was a period of stability because Glass-Steagall Act separated deposit taking from investments, and you see the stability. But then in the 80s, the Glass-Steagall Act, the banking deregulation started, and then you see slowly banking crisis. And then in the 2008, more than 4,000 banks failed. And what happened? Again, the inequality arose, and you found 10% of the population having again almost 50% of the wealth and income. So this is the downside of fractional reserve banking. Although it is very cheap, efficient in creating the what we call credit intermediation, it comes with a huge cost. And we have seen the financial system has caused huge what we call social and environmental problems. All this pollution has been caused by excessive borrowing that led to a fast depletion of the resources without ability for the planet to recover itself. Credit has been growing much faster than the ability of the world to produce. That's why we have the Earth overshoot calendar, where in May last month, we have consumed the entire needs of Malaysia, the resource needs of Malaysia for the year. So we are over consuming. And this has caused what I call character displacement. Because Islamic banks cannot offer the risk-sharing products, because risk-sharing products is more difficult to generate because it's not as fast. You can generate deposits through fractional reserve deposit. Here, your 100 ringgit can only create 100 ringgit worth of economic activity. Because that 100 ringgit basically going directly into a real economic activity, and you are sharing the what we call the upside and downside of the economic activity. So if I borrow 100 ringgit, if my company is not doing well, I still have to pay you the murabaha profit rate or the ijara profit rate, ijara rental rate. But in profit and loss sharing, if you have given to me to basically create a manufacturing entity or to run a restaurant or a food business, if the market is down due to COVID, you'll be getting nothing now, because I would tell you this profit has been wiped out because my sales is lower than my cost. And you won't get any return during this period. Although economically, this is the right thing to do because I can only share if I make profit. But because the alternative system is available where you're still getting a return, even though the companies are not making profit, customers don't want the original Islamic products. And Islamic banks go through what we call a character displacement. So instead of offering the mudarabas and musharakas, the Islamic banks then offer conventional type products through Islamic contracts. So you have the murabaha lil amir bil shira, where the banks basically sell the product to you and say, this is the cost, I'm putting a profit margin of 5%, you pay me over a period of 5 years. Or this is the vehicle, your dream car we bought for you, and we are leasing to you for 5 years at 3%, which you pay monthly over a period of 7 years, 9 years. So although this is not profit and loss sharing, it meets what we call the fiqhi requirements, the legal requirements. It may not be in line with the higher maqasid, where you are sharing the wealth equitably, sharing the profits equitably, sharing the upside and downside equitably. But it meets your immediate need. And the immediate need is you want something which is functionally similar to conventional, because that is the cheapest option today. If you do a mudaraba, it is impossible to give you a 30 years financing at 3%. I have not seen this model. There have been a lot of models in US and UK trying to do musharaka mutanakisa, where they actually share the profit. All of them have failed to get the desired result. You can see anecdotally, there will be some sample of success, but they're not mainstream. To get mainstream relevance, you need to have the market share. And market share is not possible if there's another side of the banking called conventional banking, which is protected by the state. The government gives the deposit insurance, and these are all subsidized. What I mean by subsidized is the deposit insurance, the premium for the deposit insurance is hardly anything. Could range from 5-7 basis points to 30 basis points. Your car insurance premium is about 2 to 3%. So when you buy a car and you pay a premium for your car insurance or takaful, it's 2 to 3%. But when the banks get deposit insurance, is in basis points. So that basis points does not reflect what we call the actuarially fair deposit premium. It is basically subsidized. Because of the subsidy, profit and loss sharing products become a lot more complex. That's why Islamic banks have to somehow survive by offering what we call risk transfer Islamic products like Murabaha, Ijara, Tawarruk, and Ujra to survive in the market where customers want the cheaper equivalent of the conventional products generated by the fractional reserve banking system. So in order for Islamic banks and conventional banks to remain relevant in a world where increasing inequality, wealth inequality, income inequality, inequality of opportunities, and severe existential environmental program has been exacerbated because of this COVID, both the banks need to find a relevance in the ever-changing world. And that can only be achieved by making banking more sustainable. And particularly Islamic banks, because we are guided by divine revelation, Islamic banks need to converge with sustainable finance. And we will explain now what sustainable finance is. Sustainable finance in a nutshell is about consciously measuring the impact of financing and financing activities. So if we are a bank, we need to look at how our financing products are creating impacts. Could be positive impact or negative impact. Positive impacts and negative impacts in the past have been confined to the maqasid. So when Imam al-Ghazali devised this concept of maqasid in the 12th century, he was focusing on the problems of the day. He lived in the Seljuk period, and that period there was a lot of hostilities between Islam and Christianity and the Mongols. There were a lot of what we call existential problem. So he defined maqasid based on, for example, protection of religion, protection of life, protection of intellect, lineage, and property. But today, our problems are even broader. We have problems on air, we have problems in the sea, we have problems in North Pole, South Pole. Everywhere you go, we have huge problems. You have, for example, temperature, global temperature increasing. We need to make sure we can bring it down by minimum 1.5% by the end of this century. And we need to make sure that we contain the melting of the ice in the North Pole and the South Pole, because Bangkok, Jakarta, Maldives, and many parts of the world will be underwater if you continue the way we are consuming now. And a lot of the consumptions are driven by financing. You won't be able to buy your house or your car or all your needs if there is no active financial intermediation through banking. So a lot of impact is caused through the banking products and services. So how do we make sure that our products and services are causing or creating more positive impact and having zero or less negative impact? So this is where we find the concept of Amr Ma'ruf wa Nahy al-Munkar come in to play. Islam has always been focusing on do no harm and do more good. That's the very basis of Islamic finance. So in the past, we have been avoiding sin sectors. So Islamic banks typically will not involve in money lending, interest-based transactions, including insurance companies, will not be involved in tobacco because it is destructive to the health of the community. Illegal drugs, alcohol, and gambling are addictive. And pornography, arms, ammunitions, many other sectors which are against this maqasid that destroys life, intellect, progeny, property, and so on. But today, Islamic banks need to be playing the role of Khalifa, the steward that has been the basis of creation of human, as explained by the Quran, by ensuring all the resources endowed in our planet. So if you are the trustee, if you are the steward, our responsibility is make sure that the properties, the wealth that Allah has endowed on earth and appointed us as trustee, is our responsibility to preserve it, to consume responsibly and preserve it as trustees for the next generation. So Islamic banks need to broaden the scope of negative impact beyond tobacco, drugs, alcohol, and the traditional sin sectors. Islamic banks now have to focus on, if we are giving financing to a plantation company, what is their footprints in terms of carbon emission? If they are going to plant this, using the financing, they're going to plant new trees on peat land that they have cleared, there's a huge cost to the environment. Peat lands are important ecological balance that helps, for example, flood mitigation. They are really key in flood mitigation. In many areas, we are seeing floods because we have destroyed the peat land. Peat lands are like sponge, like basins. So they shrink when there's a drought, and they expand when there is a flood. But the moment you clear the peat land, there is no natural resistance for flood. They also create a huge, what we call biodiversity, that helps protect the entire ecological balance. And they also absorb the heat, so that, you know, when there is, during the what we call summer period, the water in the peat helps to reduce the heat in the atmosphere, and vice versa, during rainy season is able to absorb. But if you were to build or plant your trees by clearing the peat, it may not be contrary to Sharia principles, because you are giving them a mudaraba financing or a murabaha financing. So from a fiqhi perspective, there's nothing impermissible. But from a overall maqasid perspective, they are destroying the environment, and therefore, as a steward, we have not discharged our responsibilities. So therefore, the role of Islamic banks need to broaden beyond just looking at the legality of the financing, but need to go towards the positive impact and the negative impact. The same goes to if this company, this manufacturing company, is not providing fair or adopting fair labor policies. If they are not giving fair wages to the migrant workers, for example, if they're not providing proper health care, if they're not providing accommodation which are what we call equitable, this again means they have not discharged their duties as stewards. There's been some exploitation, and that exploitation has been linked to the financing that we have given. So Islamic
Excuse
Bank,
me, Mr. Haneef, Mr.
Yeah.
Rafi, you have 10 minutes left.
okay, thank you. So the focus is now is to fully understand all the negative impacts and put a plan in place so that before we give financing, we can clearly identify what negative impacts there could be, and then come up with a plan, an action plan with the companies to basically to have a plan to reduce or to eliminate, eradicate the negative impacts. How do we increase our positive impact? This is the last slide. I've talked about the negative impact. The positive impact is we also need to channel the financing towards what we call sectors which need which will create positive impact. All financing will have some positive impact. By giving home financing, we create positive impact because when you own a home, you become grounded in the community. You increase the community well-being. You help in terms of creating what we call families that will be responsible citizens and help the country to achieve full capacity in terms of GDP and help the economy to grow. So every financing will have some positive impact, but we want to focus on certain economic activities that we should finance that can create the highest positive impact. So we need to look at sectors which are going to reduce the GHG or greenhouse gas emissions, like renewable energy plants, like solar plants, small hydro, green certified properties, electric hybrid cars, sustainable farming, basically eco farming, biodegradable single-use products, and also circular economy. Can we convert, for example, can we recycle cooking oil that has been disposed into detergents, into soaps, into other byproducts, and so on? Can we convert recycle plastics into bricks? Can we recycle food wastage into compost? So these are all in line with SDGs 7, 9, 12, 13, and so on. And how do we help, for example, capture the carbon, what we call sequester the carbon sequestration, linked to, for example, forest farming? How do we preserve the forest that is capturing the carbon emissions? How do we, for example, can we grow seaweed or kelp farming that can help again sequester the carbon naturally from the atmosphere? How do we do regenerative agriculture? You see, if you do proper agriculture, the agricultural produce itself will absorb the carbon. Today, we do what we call commercial farming using synthetic fertilizers, non-organic fertilizers that's actually destroy the what we call the microbes in the soil that's not able to capture the carbon. So all these things, new thinking has to come in this new age of financing. And we're also looking at, for example, financial inclusion. How do we include the B40s that are not able to afford a home? Can we create more tailored affordable home financing, microfinancing to the micro entrepreneurs? How about women empowerment? How do we make sure we get more involvement of women in CIMB, for example? We have more than 50% women in our workforce. But how do we get more women into senior management, into the board? So we have now clear targets that we need to help. And that requires some intervention, like in CIMB, we give up to 6 months maternity leave. And you can have an optional 6 months no paid leave if you want to extend to a year, so you can have a more quality time with the newborn. How do we have, for example, disability inclusion? How do you have a certain percentage of population given to people with special needs, with disabilities? So these are things, broader things, which are very much in line with Maqasid that we are trying to inculcate so that banks can progressively increase positive impacts and then also progressively reduce the negative impact and create a world which is more equitable and sustainable. So that's, in a nutshell, is the presentation. I hope I've been able to share some of the thought process that is currently emerging and trends that we are seeing in the area of finance. And certainly we are living in an exciting age where post-COVID, there will be a complete reset. Whatever you've seen in the past will be very different from what you're going to see post-COVID. And this again requires the universities to change the curriculum to adapt to the new norm, the new age of finance. Wabillahi tawfiq wal hidayah. Wassalamu alaikum warahmatullahi wabarakatuh.